Audit assertions are a common AO in CPA Canada exams. I'm going to give you 6 tips to nail the assertions every time. In university, you're taught 3 categories of assertions: balance sheet, income statement, and presentation disclosure. In CPA, you're taught only 2, balance sheet and income statement. The way you're taught at CPA Canada's program is the correct one. There are only 2. This is based on CAS 315, which is the official Canadian auditing standard. In the US CPA, there are 3 categories, but in Canada, the presentation is part of income statement and balance sheet assertions. Now, when you debrief CPA cases, you'll notice sometimes they'll put a few assertions. When I'm coaching students, I often get the question, how many assertions do I need to put to get a C? The magic number is 1 or 2, with 3 being the absolute maximum. Don't write anything more because the marker will know you're just making things up. Now, before you put down the assertions, you need to know the assertions. You can always look them up in CAS 315, but it'll take time, so you're better off memorizing them. You can memorize them with the saying, is COCCA served in Boston? Think of someone serving Coca-Cola in Boston. Every letter in his memory aid tells you what the assertion is. I dropped the presentation because it's rarely used in CPA cases. Next tip, here's a general guideline to help you figure out what assertion goes where. For assets, the most common assertion is existence. For AR, it's usually valuation and existence. For inventory, it's valuation and rights and obligation. For PP&E and R&D, it's usually classification because you're not sure if it's repairs or capital. For liabilities, it's often completeness because they're often undisclosed liabilities. For expenses and revenues, it's often occurrence, completeness, and sometimes cutoff. Remember, these are general guidelines. You have to adjust them based on the specific issues you're given in the case. Here's the next tip. For balance sheet, there's a concept called sheet to floor and floor to sheet, which tells you the direction of the procedure, either from the report to the physical items or from the physical items to the report. For example, when you're counting inventory, you can look at the report and check against the physical inventory, or count the inventory and check against the report. The first is sheet to floor and it checks for existence. The second is floor to sheet and it checks completeness. So that you don't confuse these assertions, remember the saying, I met my ex in San Francisco. Existence is sheet to floor, completeness is the opposite. Here's my last tip. For income statement, the revenue and expenses can be overstated or understated, and those affect the assertions of completeness and occurrence. Here's an easy way to remember which one goes where. When there's overstatement, it's occurrence. When there's understatement, it's completeness. Remember this connection with the letter O. Both occurrence and overstatement start with letter O. So every time you see the letter O, remember overstatement, it's occurrence. There you have it. In summary, there are only balance sheet and income statement assertions. Remember them with the saying, is COCCA served in Boston? Sheet to floor tests for existence, floor to sheet tests for completeness. When you have overstatement, the assertion is occurrence. When you have understatement, it's the opposite, so completeness. Hope you found this helpful. I'll see you next time.